Hello and welcome back to the channel. My name is Zach Collins and this is Financial Education. And welcome to part 3 of the mini-series on superannuation. This is the last video on the accumulation phase. Soon we're moving into pension phase of the super. Today we'll be going into details surrounding the different types of contributions there are and the different caps and limits, as well as the scenarios that you can withdraw your balance. For those that don't know me, what is my background? I was a financial advisor in my past, fully licensed, fully FISA compliant, specializing in super and non-super investments. I'm no longer licensed anymore, but I'd love to get it back one day. I left the industry as I could not stand the owner of the business and I've got no interest in sales. It's not all sales, but my passion is to help people, not to sell various managed funds or insurance products. These days, I work in tax. Let's start off with free money. Who doesn't want free money? No one. Thought so. Now, the government rarely gives away money for free, unlike the US where they got stimulus checks during the COVID. But unless you're on government payments or your employer was in difficulties and you got the extra payment of JobKeeper, there's no free lunch here. For low-income workers, however, there are two ways the government will boost your super balance, and that is through the co-contribution scheme and LISTO. The co-contribution used to be a one-to-one bonus. If you contributed $1,000 in non-concessional contributions, if you remember what I said last time, how concessional is pre-tax and non-concessional is post-tax. So the co-contribution requires you to contribute to super after you've already paid tax on the money in order to get to it. As I said, it used to be a one-to-one bonus. If you put in $1,000, the government would also contribute $1,000. Now, however, it's a 1 to 0.5. So you get a maximum of $500 for the $1,000 you contribute. Now, there are thresholds for contributions, which I'll link below. But basically, if you want the maximum amount, you need to be earning under 45 grand, and you still get a little bit of benefit, but it cuts down up to around the $60,000 mark. Now, LISTO is similar but different. This stands for Low Income Superannuation Tax Offset. For this one, you have an adjustable taxable income. This factors in other income and deductions, so it's slightly different to your bulk stat taxable income. And below 37 grand, you'll get tax on your superannuation paid back into the account, up to a maximum of about $500. So as I've said before, that concessional contributions pay tax at 15%. If you're earning under 37 grand and you get 12% super guarantee, that's $4,440 in contributions. You'll pay tax of $666 in tax. The government will give you back $500. So essentially, you're only paying $166 in tax on the contributions, and it really helps boost your super balance. If your spouse is a low income earner, you could also consider doing a spouse contribution. A spouse contribution is a specific type of contribution, and it would be included in their non-concessional contribution cap, as it provides the higher earning partner to get a tax offset up to $540. This is calculated on 18% of the contribution, up to a cap of about $3,000, where the income does not exceed 40 grand. So that means is if they earn 38,000 and you contribute 4, only the $2,000 difference between 40K and 38 would be counted, and you get the tax offset of $360. However, if they earn 36 grand and you put in 4K, the max you can get is offset of 80% on the 3 grand, being $540. When it comes to certain contributions, your super balance, your total super balance is very important. I'll go into more detail about the different types of contributions a bit later, but if you want to utilize your carry forward concession contributions, your TSB cannot be over $500,000, and bring forward non-concessional contributions are affected if your TSB is over $1.9 million. So what are the carry forward and bring forward provisions I just mentioned? In the 2018-19 financial year, the government started allowing people to carry forward the concessional contributions that they didn't use. What does this mean? If your employer pays $10,000 into your super and you have a concessional contribution cap of 25, which is what it was at the time, it means there's $15,000 unutilized. You can carry forward that $15,000 into the future for up to 5 years, after which it drops off. So then, in the 2019-20 year, you could have used $25,000 for that year, plus $15,000 and contributed $40,000 concessionally to your super. As I said, this drops off after 5 years. If you do want to use up the cap from previous years, what you need to do is maximize the cap for the current year. Today that'll be 30 grand, and then any amount over this will automatically be deducted from the oldest year first. Let's say you have $15,000 per year spare. If you put in $50,000 this year, you'll use up the current cap of 30 grand. 15,000 will be attributed to the one from 5 years ago, and then to the one just after that, $5,000. As I said before, if your total super balance is over 500 grand, you cannot use the carry forward concessional contributions. It's not to say they won't keep accumulating, you just can't use them. The government allows you to continue to build up those carry forward contributions because the market does not always go up each year. Sometimes you'll lose money, and so if your balance drops below 500 grand, then it's up to you whether you want to use them or not. The 3-year bring forward rule is similar, except instead of using past contributions, it uses future years. So you can bring forward up to 3 years of contributions. This is currently a cap of $120,000. The NCC cap is actually calculated as 4 times that of the concessional cap. So the concessional cap is indexed at a WOT, average workers over ordinary time earnings. Because the concessional cap increased to 30K, 4 times 30K becomes 120. Interestingly enough, if you bring forward years and the cap gets indexed, you don't get the benefit of the index cap. Let's say today you contribute $360,000. That would use up all 3 years of your bring forward. It means for the next 2 years you cannot make any NCCs. This can be hard sometimes as people contribute in many different ways, so you need to be vigilant to not breach this. If you don't use the full amount, let's say you do 150 grand, you still trigger the bring forward provisions, and that means that over the next 2 years, you can contribute a maximum of $210,000. If you make an NCC of 50K in year 2, it then leaves 160K for year 3. Now, let's say in year 3, the cap gets indexed. If you did bring forward this year, you would have 3 years at 390K instead of 360. The additional amount does not get added to your current limit. You are limited to what the cap was at the time that you started your bring forward. An additional thing that needs to be factored into your non-concessional contributions is a transfer balance cap. If your total super balance is over 1.9, you cannot contribute any NCCs to super. If your balance is over 1.78, you cannot use the bring forward and you can only contribute up to 120K. If your balance is over 1.6, you can only bring forward 2 years and contribute up to 240. And if your balance is below 1.66, you can use all 3 years for 360 grand. I'll link the ATO website below where you can get more information. As you can tell from the different types of contributions, the tax treatment of these contributions differs. That doesn't matter for you or your spouse, but it does matter for any dependents that may receive your super balance upon passing. There are 3 types of super balances: tax-free, that is your non-concessional contributions, and it gets paid to your beneficiaries completely tax-free. Taxable taxed, this is your concessional contributions, and it gets a 17% tax applied to it. That's 15% tax plus 2% for Medicare levy. Finally, we have taxable untaxed. It's not a very common type of contribution type, such as for certain government and defined benefit funds, where they don't tax the money coming in and only on the way out. Why am I talking about this? That's because there's something called the recontribution strategy. Older, wealthy families use the recontribution strategy to turn their taxable taxed amount into tax-free. How do they do that? Firstly, they need to be able to access the super and pull it out tax-free. Then they recontribute the super using non-concessional balance and any bring forward provisions they can and put the money into super where no tax is taken from that amount and is now part of the tax-free balance. Important to note is that when I say wealthy, this is people that aren't already maximizing those NCC contributions. They might have 1 to 1.5 million super. They're in the top few percentile of super balances and wealth, but they're not the ultra wealthy with multi-millions in super. The other thing when it comes to super is when you want to recontribute to super, you want to make sure that you put that amount into a different account. This is because if it was to mingle with your current balance, let's say you got a $500,000 balance, fully taxable taxed. You pull out 300K and then you recontribute a 300K. You can either have 2 balances, one with 200 grand, which is fully taxable tax, and a second of $300,000 fully tax free. Or you can have one balance of 500K, but 60% will be tax free, 40% will be taxable taxed. If you were to then do the recontribution strategy a second time, in the first scenario, you could pull out just the 200K, just the taxable taxed, and you could then put it back into the tax-free account. However, in the second scenario, unless you pull all of it out, only 40% of what you pull out will be taxable taxed, 60% will be tax-free. So you're pulling out money that you don't want because the percentage does not change with withdrawals, and you cannot specify what type of contribution, what type of fund balance that you pull out. There are other types of contribution that I'll go into quickly. The first is the downsizer contribution. It's an attempt to get people to free up large freestanding homes by older people. The requirements are they need to have owned a home for more than 10 years and have lived in it for some time, and it is eligible for the main residence exemption, either full or partial. Currently, you can only put in about $300,000 per person, and you have to be over the age of 55. When it comes to the downsizer contributions, it completely disregards all other contribution limits. There's also something called the Small Business CGT Retirement Exemption. I'll put a link in the description for more information. The final contribution that I want to mention is something very specific, and it's called the COVID recontribution. This is only available to people that withdrew money during the COVID release of funds. There is a specific form you need to fill in if you want to claim it. However, this is allowed on top of your NCC limit, and it's not allowed to be made as a concessional contribution if you want to use this limit. So if your cap is say 120, you want to make a contribution of 130, you'd fill in the form and get the ATO to recognize that the extra 10K that was over the cap was a COVID recontribution. That's it with the contribution types. Whew, that was a lot. Hopefully there's a few people still watching. Before we move on, there are a few things to keep in mind when you make a non-concessional contribution and you want to turn it into a concessional contribution. Essentially, to get a tax deduction on that amount. In order to do that, you need to lodge an NOI form for the fund. NOI standing for Notice of Intent to Claim a Tax Deduction. This needs to be done before you make any transactions on that account. If it's done after, it will be invalid. So you need to make sure you lodge the form and it gets acknowledged by the fund before you roll over to a new super fund or before you start a pension with that balance. When it comes to timing, the latest you can submit the form is either before you lodge your tax return for the financial year or the end of the next financial year. So let's say you make a contribution on the 25th of June, 2025. You can only claim the deduction in the 2025 financial year. And if you want to claim it, you need to make sure you lodge the form before you lodge your tax return, being the end of October 2025, if you lodge yourself, or mid-May 2026 if you lodge with an accountant. Bear in mind that this is also the last point you can claim. If you lodge your return before those dates, you're too late. If you don't lodge your tax return at all, which everyone should be doing, you have until the 30th of June 2026 to claim that tax deduction. If you send in the form after any of those prior mentioned events, it's going to be completely disallowed. Now moving on. So super is generally locked and untouchable. I'll go into a few scenarios that you can access it earlier. You can potentially do it for certain medical reasons or if you're under financial distress. I won't talk about those today, but I'll link more information to these on the ATO website. If you're on a temporary visa, you can claim your super when you leave the country. This is known as DASP, or Departing Australia Superannuation Payment. There are a lot of people online that think if they leave the country temporarily, they can access the super. That's not true. The requirements to claim are that you accumulated superannuation while working in Australia on a temporary resident visa issued under the Migration Act. The visa has ceased to be in effect, so either it's expired or cancelled. You have left Australia and you do not hold any other active Australian visa. And finally, you are not an Australian or New Zealand citizen or a permanent resident of Australia. So if you ever get your PR or your citizen, you can never access your super early using the DASP. I'll leave a link in the description for more info. However, be mindful that your super will be taxed. I've got them on the screen for you now. As you can see, working holiday makers pay a much higher rate of tax on the super withdrawal than other visa classes. There are two main ways, however, that the average person can draw money on their super as an Australian resident. The first is using the First Home Super Saver Scheme, which I've mentioned in the previous video. This is where you contribute money to super up to about $15,000 per year, which is allocated to your FHSSS. And other is by meeting the preservation age and condition of release rules. At this point in time, preservation is age 60 for everyone. There was a time when it was 55, but over the last few years, the government has been slowly raising that age. What does preservation age mean? It means your balance is preserved and you cannot touch it, other than for the reasons I discussed previously, until you meet that age. This is the first condition. The second one is if you are between the ages of 60 and 65, you need to cease a gainful employment. All this means is you need to change jobs, or if you had two jobs, as long as you leave one, you can access your super. If you do this at 60, your total balance is now unpreserved. However, any future contributions will be locked if you haven't fully retired and you're still working. Once you hit age 65, you can work as much or as little as you want, and your total super balance is now unpreserved. And you can do whatever you want with it. If you're still working, your employer still needs to pay SG. However, if you want it, the second it went into the account, theoretically you could take it out. When it comes to accessing your super after you pass away, there are a lot of requirements that need to be met. Maybe I won't discuss the difference between tax dependent and super dependent here. That is a video in itself. I'll probably release one next month, we'll see. But in order to get super from a deceased estate, you need to be a super dependent. A lot of people get wills, and they believe that their super would be included in that and paid out to the beneficiary that they have in their will. This is not the case. One thing that you need to be aware of is that super is not your money. I mean, it is, but it isn't. You are the beneficial owner of the account, but you are not the owner. The super fund is. Due to this, if you pass away, super is not an estate asset. Your house and your cash will be part of your estate, but your super will be paid out as per the beneficiary nomination that you have made. This means it's super important that your beneficiary on the account is valid and is up to date. The limited beneficiaries that you can name are essentially your estate, your spouse, and your children. You cannot name grandchildren, siblings, parents, nieces, or nephews. That's very limited. If your nomination is not valid, the trustees of the fund can essentially decide themselves who they want to pay the money out to. They have to pay it out. But if you want it to go to your sibling, this is invalid, and they will make their own decision who gets it. You never know if you would be satisfied or not with their choice. Hopefully I've been able to help you better understand the different contributions and the caps and also the requirements to pull money out of super. We'll take a little couple of months break, and soon I'll be talking about pensions. So make sure to subscribe and get notified when that comes out. If you've got any more questions, please feel free to drop a comment below and I'll answer if I can. Thank you guys so much for watching, and I'll see you on the next one.